With inflation ticking up for the month of September, where does this leave the Bank of Canada ahead of its next policy rate decision coming up on October 29th? Do we have any insights from the business and consumer outlook surveys that could point us in the direction about what the Bank of Canada will be doing next? Keeping in mind that we have 2 more meetings, obviously the 29th and one in December to end off 2025. And a lot of Canadians are asking that question, will we see the Bank of Canada cut? We're going to unpack our thoughts and opinions this week. Once again, thanks for stopping by. If you haven't subscribed to the channel, please consider subscribing. Doesn't cost you anything. Hit that subscribe button while you're down there. Hit that notification bell so you can stay up to date with everything that's happening in the mortgage and real estate marketplace. More importantly, we want to hear from you, our viewers and clients, in that comment section below. Let us know your thoughts and opinions down there. More importantly, if you learned something or picked up something new or know someone that could benefit from this content, please share the video. Now, let's get right into it. So ultimately, right now, we have a little bit of a conundrum when it comes to the Bank of Canada's next policy rate decision, at least when we talk about inflation. Inflation came in a lot hotter than expected for the month of September, coming in at 2.4%, as opposed to the previous month of August coming in at 1.9%. So with core inflation, CPI, medium, and trim, those particular numbers that strip out volatile things like food and energy, ultimately still hovering in and around that 3% mark. It tells us a lot about where inflation is. It's basically not necessarily cool. There's still a lot of underlying pressure, and ultimately that may send a different message from the Bank of Canada, obviously, or to the Bank of Canada. But ultimately, what was causing this inflation to tick up for the month of September? Well, same culprits as usual. Food prices have risen 4% year over year. We definitely saw rents up 4.8% year over year for the month of September. And although you may be asking yourself, how are rents up? Mortgage rates are down, so mortgage interest costs for a lot of these landlords should be down. I mean, ultimately more inventory hitting the market. We still had a 3% immigration increase in the previous year. We still have higher costs, insurance, property taxes, all the things to maintain those particular units are being passed on to the end user, the renter of that unit. You also have to understand there's a lag here, right? It's like a hangover effect. A lot of people locked in these higher rates years ago, maybe for longer terms. But as we continue to see gas prices had dropped a little bit, obviously that still hadn't dropped as significantly as many had expected. And inflation is easing, but still above the Bank of Canada's 2% target. Remember, we talked about inflation. The Bank of Canada is wanting to stay within that 1 to 3% bandwidth. It can't be too hot, it can't be too cold, it has to be just right. So ultimately right now 2.4% may not really move the needle for the Bank of Canada, especially because if you take it in isolation, 1 month of data doesn't necessarily set a trend. Just shifting gears, looking at the Business Outlook Survey, this is a key data point. Obviously the Consumer and Business Outlook Survey are key points for the Bank of Canada. That's why they run these surveys, so that they can get a little bit of an insight on what's happening in the business world and in the consumer world. And if we flip to the Business Outlook Survey right now, overall business sentiment remains subdued. Business indicators, obviously these indicators are still negative, right? The fact that businesses are not investing, they're not hiring, they're slowing down on a lot of the investment that they would be making generally in a more positive market. So businesses also expect weaker demand and slower growth ahead, which means, they're going to also plan for that accordingly. As we discussed, hiring not happening. We saw Canada, unemployment still ticking up at 7.1%. I think it's a little bit higher than that in some provinces, but ultimately youth unemployment is even worse than that. I would say probably double that. And obviously recession expectations are pretty prevalent right now, with 33% of firms interviewed or surveyed believe that we will be in a recession in the next 12 months. Labor shortages continue to, basically be subdued. They're just not hiring those positions or posting positions. So obviously that is a sign of a cooling economy, not really a positive sign, not a rosy picture. And at the end, business is focused on managing costs, not expansion, like we just summed it all up in that particular sentence. So businesses just want to basically survive right now. They're not looking to grow They're just looking to weather the storm. Now, looking at the consumer expectations, ultimately, this is there's a little bit of a spillover here. I mean, ultimately, the sentiments are generally the same. One are businesses, one are consumers. Consumers are more worried about job security. It should come with no surprise if you're, whether in the public or private sector, if there is a recession, jobs will get cut, especially amongst the younger Canadians. Spending intentions improve slightly for older Canadians or high income earning Canadians, not for smaller families with tighter budgets or less income. Those are actually pulling back. So younger and lower income households remain very cautious. And that is a sentiment that we're hearing not only from the business or consumer outlook survey, I should say, but from actual Canadians when we're reaching out to them, we're talking to them at the renewal time, we're looking at certain parameters. Some of them may have gotten pay raises. Obviously, their pay increases are not keeping up with the pace of inflation. And, obviously they're having children, rent, insurance, everything's a little bit more expensive. 65% of Canadians expect, according to the survey, expect a recession within the year. And that's not really a good sign. I mean, that's very negative. It's a negative outlook. Inflation expectations, 3.5% to 4%, I should say, are expecting inflation to increase in the next, 12 months. And with that, that's not a positive sign. If we just sort of pull back and say, well, if you think things are going to get more expensive in the next, 6 to 12 months and you need to make a big ticket purchase item, are you going to do that now or are you going to do that later? And obviously providing your financial situation, your budget obviously allows for that. But some Canadians might say, hey, it's better to do it now than to wait. And that's something that the Bank of Canada does not want to see. They want to see expectations drop. I believe personally, and you can agree or disagree with me, let us know in the comment sections, but sentiment is what drives an economy, right? Obviously, employment, stability, cheap interest rates, leverage, borrowing money drive an economy, but sentiment, right? The euphoria, what people feel when they feel strong, they feel comfortable in their jobs and ability to earn and have children and go out there and buy a property or contribute to the economy. That is the biggest ticket. And when we see that confidence turn over as a result of many different factors, we could see some turnaround there. And ultimately, Bank of Canada likely to cut rates slowly. I mean, this is sort of a takeaway. They've been doing that, right? They did pause for a bit. They cut at the previous meeting. Potentially, maybe they will cut again now. I do think that we're going to see a cut between now and December, maybe potentially 2 cuts. Because the economy is continuing to show signs of weakness, even though the Bank of Canada may think that inflation is running a little bit lower based on their framework, based on all these different calculations. At the end of the day, the average Canadian doesn't see it, doesn't feel it. And obviously, Bank of Canada, looking at these things maybe through different lenses. We'll find out, as I said, more on October 29th at the press conference. We'll be doing a follow-up video to discuss that. But when it comes to the mortgage implications, short-term and flexible terms are the most popular right now. I mean, that's literally when we're talking to clients about the renewal, whether they're sticking with their existing lender or they're moving to a different bank and restructuring, the short-term products are the ones that are winning out. And that is like basically your 3-year options as opposed to your 5-year products. Now, obviously, there's a lot to be said about variable products. That is obviously a different conversation because a variable rate mortgage, whether it's a 3 or 5-year product, depending on where the heavier discount is, most Canadians will take the 5-year as opposed to the 3, depending, because of the fact that it's always a 3-month interest penalty to get out. Obviously, we'll talk a little bit more about that. So the lock-in options can provide, obviously, certainty amongst volatility. A lot of clients that we're talking to, even though the variables for some, they're having this conversation, looks more attractive because there's a potential for lower rates. These particular higher inflation data points throw a wrench into those conversations and that thought process. So ultimately, for certainty, a lot of Canadians just want to be able to put their head to bed at night knowing, hey, I'm locked in at this rate for the next 3 years. My payment won't change. And ultimately, what their appetite for risk is. And smart financial planning matters even more right now. Remember, budgeting, understanding, if you're in a volatile or an industry that your job could be on the line, is budgeting and planning accordingly. And, always make sure to review your mortgage ahead of that mortgage renewal. Don't leave it to the last minute where you're stranded, you're struggling. A lot of clients reach out to me with like 10 days left and say, hey, my mortgage is coming up for renewal. What can we do? I'm like, not much. 10 days. Some banks require more than that to actually get the appraisal if one's required, and do the whole switch and transfer over, especially if you want to save on legals. Ultimately, if you have questions about your mortgage, if you have any questions about your renewal and you just want a voice or an ear to listen, set up a call, send us an email. We'll be happy to have a chat with you. More importantly, What do you think is going to happen with the Blue Jays? You think they're going to take on the Dodgers? You think they're going to win in the World Series? I would hope it. It's been a long time since Canada and the Blue Jays have been in the World Series. But want to hear from you in the comment section. Let us know what you think the Bank of Canada is going to do on October 29th. And do you think the Jays can beat the LA Dodgers? Let me know. But until next week, have a great time. Have a great weekend. And we'll see you guys all very soon.